Hello all, in this video we are going to discuss subsequent measurement of lease liability. So initially we have calculated the amount of lease liability over here. So we have calculated the amount of lease liability as 248,409.5, and this calculation is made on 1st December 2015 when we entered into the lease contract. So this is the initial measurement of the lease liability. In this video, we are going to discuss how do we treat this lease liability in the subsequent years. That is, this amount will be shown in the balance sheet for the year ended 30th November 2016. From then on, how we are going to treat this lease liability in the second year, third year, fourth year, that is 16 to 17, year 17 to 18, year 18 to 19, how we are going to treat this lease liability. And that is what we are going to see in this video. So the carrying amount of the lease liability is increased by the interest charge. So if there is, you need to calculate the interest by applying the interest rate to the lease liability. So you will understand it better when we start solving the example below. So the lease liability will increase with the interest charge, and you need to pass this journal entry for the same. That is debit finance cost. This finance cost is nothing but the interest expense, and credit lease liability. You are debiting finance cost, but because it is an expense, interest is an expense. So debit all expenses, the uncredit all incomes is the golden rule. So you are debiting the finance cost and crediting lease liability because any increase in liability should be credited. The carrying amount of the lease liability is reduced by cash repayments. So if you are repaying the liability, then your liability is reduced. So you're debiting the liability, and the cash is going out. Since you're making cash repayments, cash is going out of your business. The golden rule says that debit what comes in, credit what goes out. Since cash is going out of your business, in this case, you need to credit cash. This is the format that you need to use while calculating the lease liability, subsequently measuring the lease liability. If payments are made in arrears, then you need to use this format, and if payments are made in advance, then you need to use this format. So what is payments made in advance and what is payments made in arrears? So first, let's look at what is payments made in advance. So if the fixed payments are made at the beginning of each year, then it is known as payments in advance. So here we have an example. See here, rental payments of $75,000 are made in advance on 1st December each year. So it means that the fixed payments, the rental payment of 75,000 is made at the beginning of each year. So this is an example for payments made in advance. So if payments are made at the end of each year, then it is known as payments in arrears. So for example, let's say that instead of 1st December each year, if they have given 30th November each year, then it is known as payments made in arrears. In case of payments made in arrears, use this format, and in case of payments in advance, use this format. And the difference between this balance carry forward and subtotal will be your current liability, and this subtotal will be your non-current liability. You will understand it better while solving the example below. So here is the illustration. Sadio leases the machine from BH for 5 years on 1st December 2015. So Sadio is the lessee, BH is the lessor. Rental payments of 75,000 are made in advance on 1st December each year. And the first installment has just been paid. And useful life is 7 years. Lease arrangement fee 1,500. Implicit rate is not given, so we are going with the incremental borrowing rate. And ownership is not transferred. And the question is, show how lease liability will be measured subsequently for the year 2016 to 17. So here they are asking us how we are going to measure the lease liability in the second year. Here is the solution. See, this is the first year, that is 1st December 2015 to 30th November 2016. The lease liability is 248,409.5, which is nothing but the amount that we calculated previously, and no payment is made in the first year because see, rental payments of 75,000 are made in advance on 1st December each year, and the first installment has just been paid. See, even here I have explained you that this 75,000 made on 1st December 2015 is not a part of your lease liability because this is not a future payment. It has already been paid. So for lease liability, you need to, for calculation of lease liability, you need to calculate the present value of future lease payments. So this 75,000 is not a part of lease liability. So you will, it has not, so it's not a part of lease liability. So no payment is made in the first year here. So it is zero. And the difference between the liability and the payment is your subtotal. And you 248 409.5 minus 0, you get the same amount, and you need to charge 8% interest on this subtotal. So you get 19872.8, and you need to add this interest to the lease liability to get the closing balance, because here it is told that the carrying amount of the lease liability is increased by the interest charge. So this is the interest charge here. This 19872.8 is the interest charge here, and this 19872.8 will be shown in the statement of P&L on the debit side for the first year. And this is your closing balance. This closing balance is nothing but summation of these two, subtotal and the interest. And for the second year, you just, the closing balance of the first year becomes the opening balance of the second year. So you need to put the same amount here, and here a payment of 75,000 is made here on 1st December 2016. We will make a payment of 75,000, and that 75,000 is this one, and a payment for this year 16 to 17 is made, and you need to reduce your lease liability by this 75,000, and you get a subtotal of 193,282.3, and you need to charge 8% interest on this amount now. Okay, so this is the carrying value of your lease liability now. So you need to charge 8% interest on this, and you need to add these two to get the closing balance of the second year. So in a nutshell, this is important. Also, this current liability is nothing but this 75,000, and your non-current liability is this closing balance minus, your current liability is this closing balance minus this amount, the subtotal, that is 75,000, and your non-current liability is this 193,282.3. And to summarize it, so this amount, this interest will be shown in the statement of P&L for the second year. On the debit side of statement of P&L, you will show this amount as interest expense, and in the liability, current liability section, you will show the 75,000, and in the non-current liability section, you will show this 193,282.3. Also, I have roll forwarded the figures up to the end of the lease term, that is for the 5 years. So whenever you're free, you just go through it. Same procedure. Closing balance of the second year becomes the opening balance of the third year, and a payment of 75,000 is made in the third year. Difference between these two will give you the subtotal. Charge interest, 8% interest on this subtotal. You add these two, you get the closing balance, and follow the same. Closing balance becomes the opening balance, 75,000 payment. Difference between these two becomes a subtotal, and charge 8% interest on this. Add these two, you get the closing balance 75,000. Bring this, carry forward this, bring forward this, and payment is made at the end of this, the last year, 5th year. Payment of 75,000 is made, and it becomes zero. So at the end of the lease term, your liability will be zero. Everything will be paid off.